Hello and welcome to Smartkarma's corporate webinar. I'm Anisha Kundu and I lead the corporate solutions team at Smartkarma. This week, we have with us BNI's IR team led by Yohan Setio. And we will start the webinar with Ananda Elise giving us a short walk through the company presentation. And then we will have a fireside chat with the IR team and Daniel leading them through that. We will take live questions, and so please button the questions to the Q&A button at the bottom of your screen. And during the webinar, I will also be sending in a few helpful links in the chat button, so do look out for those. And with that, I hand it over to Ananda Elise to make the company presentation.
Thank you, Anisha. Good afternoon, ladies and gentlemen. Thank you for joining session for today. And probably we will start the meeting to give some highlights about our first half financial results and also several corporate transformation we have done this far. Continuing latest positive trend during first quarter 2021, most of our financial indicators are showing solid improvements. PPOP at 8.2 trillion rupiah was the highest quarterly number we have ever booked. There was a slight compression on net interest margin due to lower yield in marketable securities, while loan yield was relatively stable. At the same time, we also managed to lower cost of fund by 10 basis points quarter on quarter. Loan at risk improved by 110 basis points to 25.8% on June, thanks to gradual recovery of client situation under restructured category. Despite improving trend in loan at risk category, we continue to be conservative in building provisions with 3.5% cost of credit in second quarter 2021, stable quarter on quarter. We believe this is a prudent approach as the country is still fighting against Delta variant of COVID-19. Next slide. The reason for strong PPOP in second quarter was solid top line, both from net interest income and fee income. On net interest income, we managed to maintain stable loan yield while at the same time deliver loan growth above industry average. We were also closely managing cost of third-party fund by reviewing counter rate time deposits from time to time, as well as focusing on building sustainable CASA. Almost all fee income components showed strong rebound. Trade finance, for example, was growing by 20.4% year-on-year and 32.1% quarter-on-quarter due to strong commodity demand from developed countries. In addition to macro factor, the growth was also a sign of preliminary result of our focus on fee income area within wholesale banking, as well as we mentioned earlier this year. E-channel, without any doubt, also grew strongly by 9.8% year-on-year, in line with shifting consumer behavior toward digital banking services. To highlight our loan mix, during the pandemic time, we are fine-tuning our loan mix composition. Probably we can see it in the next slide. Okay. So this is, we can see our loan growth in the first half of 2021. We are fine-tuning our loan mix composition toward low risk portfolio. Hence, we could see that loan growth was dominated by corporate segment, subsidized micro loan or KUR, part of a small business loan, as well as secured consumer loan. In line with our strategy to improve asset quality, we selectively let go some clients in medium segment and build new good portfolio. During the process, it resulted in 3.3% portfolio contraction year-on-year for medium segment of our loan. In the next slide, we can see about the presentation related to our third-party funds. As loan demand hasn't fully picked up, CASA growth alone was enough to meet loan demand. This enabled us to keep improving CASA ratio of 69.6%, the highest level we have seen in the past 10 years. In second quarter 2021, our cost of fund was only 1.64%, the lowest level we've ever had. We are still seeing room to improve it further as we cut our time deposit rate again by 10 basis points starting on August. We will always focus on sustainable growth of low-cost funding. In wholesale, it will be driven by our effort to cross-sell cash management solution to clients. In retail, we are going to keep investing in mobile banking features and reliability. And the next slide, we can see our profit and loss. Net interest income grew by 18.2% year-on-year, thanks to our strong CASA franchise that led to successful reduction of cost of fund. Non-interest income grew by 19.2% year-on-year, driven by marketable securities, e-channel fee income, and trade finance business from gradual recovery in global trading activity. Operating expense grew by 12.7% year-on-year, driven by an increase in personnel expense. And on general and administrative expense, we remain cost-heavy with flat growth year-on-year. As we delivered 7% positive jaw between income and OPEX, PPOP grew strongly by 24.4% year-on-year. Net-net, bottom line profit increased by 12.8% year-on-year and 7% quarter-on-quarter. And then let me give you some highlights on asset quality. As of June, the outstanding COVID restructured portfolio was 81.8 trillion rupiah or 14.4% of total loans. This amount continued to decline since December last year, with all segments showed improvement across the board. During second quarter, there was some new restructured loan under corporate segment, mainly from client in general contractor, which we already assigned 21.7% of provisioning coverage. Despite regulatory relaxation, where banks are allowed to classify all COVID restructured loan under collectibility 1, we choose to assign classification as much as possible to reflect the client's underlying situation. And the next slide. Overall, asset quality data showed a gradual improvement trend. Loan at risk was 25.8% of total portfolio, 110 basis point lower than March position. And now looking into the component of loan at risk one by one. Restructured loan collectibility 1 has improved by 16% of total loan from 17.3% in March 2021, or 100 basis point decrease. Collectibility 2 ratio increased by 30 basis points, triggered mainly by an exposure in middle segment, mostly from trading, restaurant and hotel, basic services. And for collectibility 2, we already built 46% provisioning coverage as of June 2021. NPL improved by 20 basis points to 33.9%. However, all of this movement has been in line with our expectation. In the next slide. Despite general improvement in loan at risk ratio, we are still consistently building higher provision coverage. NPL coverage was at 215.3% and loan at risk coverage at 32.9%, higher than the previous quarter. For those in collectibility 2, the provision coverage was 46%, much more conservative than regulatory suggestion. Provision coverage for current restructured loan was 10.5%, as we believe only a small portion of this bucket, around 12%, is having high risk of downgrade to collectibility 2. Also, to highlight the new capabilities we have developed into second quarter as a result of our progressing corporate transformation. We can see in the next slide. One of the corporate transformation goals in wholesale segment is to capitalize on cross-selling and upselling. We want to offer comprehensive solution to corporate clients beyond plain vanilla lending. Hence, we strengthen our investment banking capabilities by upgrading BNI securities team and establishing Singapore office. Next slide, we can see about our digital front. We are speeding up our digital transformation. On 5th of July 2021, we launched our new mobile banking app, which have various features like biometric login, digital account opening with facial recognition feature, digital loan, investment in bond mutual funds, QR payment, and etc. This all is to push our consumer using to be able to have all in one platform. And the number of mobile banking customers continue to grow 57% year on year, reaching 9.3 million users. Next, about BNI Expora. In 2020, small medium enterprise contribute to 14% of Indonesia export, and government has been targeting the contribution to increase to be 22% by 2024. To achieve this, SMEs need to be supported by all parties, from government, institutions, to banking industry. Also, BNI Expora offers various value-added services, for example, global market access, advisory on how to do export, integrated business productivity tool to upgrade SMEs business, and etc. And next slide, please. For BNI Expora, we are focusing on SMEs with potential to go global, which has 3 target markets, namely established exporter, new exporter, and exporter supporting businesses. To begin with, we opened Expora hubs in 7 cities in Sumatra, Java, Bali, and Sulawesi. So far, we received very positive response with various constructive feedbacks from our customers. To end the presentation, based on latest situation in our economy and banking industry, our management has decided to fine-tune our final year 2021 guidance. Loan growth target is revised to be 5 until 7%, factoring potential impact from social restriction to loan demand. We believe at this level of growth, we are still growing higher than the industry average. However, the growth will continue to come from lower risk segment. Net interest margin is revised upward to be 4.7 until 4.9% to take into account continuing cut in time deposit rate. Cost of credit guidance remains the same at 3.3 until 3.6%. Since the beginning, we have been very conservative in building for provisioning charges with ample buffer for unanticipated development related to the pandemic. Hence, recent social restrictions should not change the picture. And now I will return the presentation over to the moderator. Thank you very much.
Thank you for that presentation. Thank you. What I'd like to do now is introduce the head of IR, Mr. Yohan Setio, to join us for a discussion around your bank in a little bit of detail, if that's okay. And as and when we have some questions, I will introduce them into the discussion. Is that all right, Yohan?
Sure, Daniel.
Okay, good. Thank you. The first question I have is really with respect to credit costs and building what is a conservative buffer. We've seen in so many countries across Europe, in the US, a lot of countries in Asia, so many banks had taken far too much in the way of provisions. They built up far too much in the way of loan loss reserves. I'm just wondering, what will BNI look at before you decide to possibly lower your guidance? I know you've kept it the same for now on credit costs, but at what stage will you lower that? What are you looking for in the economy or in your own financial statements?
All right. So actually for cost of credit, what we are looking at before we make decision whether to increase it further or lower it, the cost of credit is, number one is our coverage, NPL coverage and loan at risk coverage. That's the most important metric. We want to make sure that our coverage ratio is at least at par with our closest competitor like BRI, Mandiri, BCA, etc. If you see our latest financial result as of June, our NPL and LAR coverage has been in line with the peers. So LAR coverage was around 33%, NPL coverage was around 2.1, 2.2 times, and we are happy with this level. We are going to maintain this level at least for this year. And the second thing that we are looking at is the progress of asset quality in our portfolio. So we are looking, for example, what is the progress of the restructuring, whether the restructuring has been declining. And then we also look into the client situation by doing survey. So maybe we are the only big banks who are doing a survey to the clients on every 4 months basis. So every 4 months we do the survey to create a basis for us to make a decision regarding the provisioning level that we need to book. And so far, based on the latest 3 surveys that we have been doing, we have seen consistent improvement in asset quality.
Good.
So which means that next year, we believe that our cost of credit should be significantly lower than this year. So for this year, the target for cost of credit is between 3.3 to 3.6%. Last year was higher than 4%. Next year, we are looking for probably around 2.5% level. We are at the moment in the process of doing another survey for asset quality that we expect to release the result to the investor, to the analyst by next month.
That will be very interesting. I think a lot of people like this high frequency data to understand what's happening behind the scenes. And I think it makes sense to see a credit cost much lower next year. It will be interesting though, Yohan, if maybe that happens a little earlier, possibly in the 3rd quarter, possibly in the 4th quarter. There's a lot of questions coming through, just so you know. One question that's coming through that I think is interesting is in loan growth. What sectors are you seeing any changes in trends? Not where you're focusing. It's clear your SOE corporate loans are going down, your payroll loans are going up because that's part of your focus. But where are you seeing major trend changes in the industry?
Right now, we see that the consumer loan is still quite strong, quite resilient despite of the pandemic. On the other hand, if we look into the wholesale segment, capex loan or investment loan is still weak. When we talk with our corporate clients, most of them still prefer to wait and see. They want to make sure that the pandemic is really well controlled before they decide to do expansion. So right now, overall for the loan growth, we do not expect a very strong loan growth. We think that high single digit is okay as long as we are targeting the right segment, the right target market. And also for the time being, we focus on the low risk of product, mainly on KUR or subsidized micro loan. There is no particular industry sector that we are targeting. On general, we believe that every industry sector, there must be like 2 or 3 top players, and we are targeting that top player within each industry, which we believe will be the winner in the industry. As long as we are targeting this top player, we believe that the loan growth will be healthy in our portfolio.
So from what you said, it sounds like consumer is maybe the strongest loan growth segment right now in Indonesia, not only for yourself, and the micro personal lending. What would be beyond, below that? What other segment is growing strongly and is maybe stronger than it used to be?
I would say after micro subsidized, after number 1 is subsidized micro loan, number 2 is consumer, particularly mortgage. Number 3 will be the private sector corporation, the blue chip names. They are still doing some expansion. For example, we heard names like Salim Group. They did acquisition of Pine Hill in South Africa earlier this year, and we were the one who give financing to this Salim Group for that acquisition financing. And then also some other big conglomeration. I think those 3 are still doing good. But if we talk about like state-owned enterprise, they are, I think in terms of balance sheet leverage, they are quite high at the moment. So they are at the moment delaying their expansion. They are expecting more capital injection from the government before they do their business expansion again.
Okay, that's interesting because that could come at a time as your credit costs are going down. So it could have a double positive impact on overall returns. That's interesting. Another question that's coming through is very specific to the digital transformation. It's a lot of times investors and analysts, we want to have hard and fast numbers, and I know that's not easy for you to give. But is there anything that we can understand about what projects you're prioritizing for your digital transformation? Maybe one or two project names, and what sort of impact you expect those to have on the business.
Yeah, so I think number one is related to strengthening the position of our mobile banking apps.
Okay.
So this project is ongoing. We started to do transformation on the mobile banking apps starting at the end of last year and still ongoing until now. So far it has been almost a year since we started to do the transformation of the mobile banking apps. And we have seen quite a good progress. For example, one of the indicators that we are looking at is the rating, customer rating in the Android Play Store. Last year, our rating was the lowest among major banks. But now we are the highest among all banks in Indonesia. Even compared to the pure digital bank, our rating is still higher. So it proves that customers are quite happy with our new mobile banking apps. We just launched the newer version on July, just a couple months ago.
Okay.
At the same time with our diamond anniversary, the 75-year anniversary of BNI. And we are still going to equip more and more features in the mobile banking apps, connecting our mobile banking apps with various ecosystems out there. For example, some of the ongoing project is how to digitize the loan process, retail loan processing. For example, right now, we already offer multi-purpose loan or non-collateralized loan through our mobile banking apps. What's next is the KUR or subsidized microloan. We are going to offer it also through the mobile banking apps.
So they can apply through the phone for a loan. Correct. And get approval through the phone.
Correct.
And disperse directly into their account.
Yes.
Okay.
So this is the closest one that we are going next to complete, hopefully by the end of this year. So our goal, number one, is to maintain our position as the number one rating in terms of customer satisfaction. And then we expect that it will translate to the number of transaction, frequency of transaction, and eventually to the amount of CASA within our balance sheet. Right now, out of all savings account, around 60-70% is coming from the active user of mobile banking apps.
Right.
We're happy with this, but we want to optimize it further because right now, out of all regular customers in BNI, the percentage of customers who are active users of mobile banking apps is still only 45%. We want to boost it further, maybe around 70-80%. That will be ideal case for us. So number one is mobile banking apps. Number two is related to the lending product. As we know that the BNPL or buy now pay later is a booming business in other countries, in India, in China, in Australia. In Indonesia, it is still very, very new. And we are one of the early adapters for this BNPL business. The size is still very, very small, but we already signed agreement with two major e-commerce. One is Traveloka. Traveloka is the unicorn for traveling business. Second is with Shopee. We just signed the agreement last month. And soon, within second half of this year, we are going to sign agreement with two other major e-commerce. So we want to make sure that by being the early adapter, we capture the business opportunity in BNPL business.
Okay, that's good to hear. There's a few questions about digital banking, about fintech. And this is a theme that we see across Asia. Clients are always interested in this point. For BNI, there's a growing number of digital banks. And I'm just wondering, do you think this is a competitive threat for yourself? Would you want to launch your own digital bank by any chance?
Okay, so I think the emergence of new digital bank actually push our people to be more creative. We are becoming more customer oriented.
I think so too.
We do not think that all banks has to be a digital bank, but we need to digitize our process in order to be more customer oriented. We are a universal bank.
Yes.
70% of the business are wholesale and only 30% retail. So we
Yes.
are not the right candidate to be converted into a digital bank because we are mostly of wholesale banking.
That's
But we
true.
want to digitize the process, at least in retail banking. I mentioned some example, our initiative in the mobile banking apps. Now we are #1 in rating. Also in the BNPL product, we want to fulfill what customer wants from the banks like us. We are doing it in the right manner. We believe that our business will not be disrupted by digital bank because, again, we are predominantly wholesale banking. #2, we are targeting different target market. As I think all of us know that these digital banks, they are having a very high cost of funds. Like their savings account is already like 4% plus interest rate. Their time deposit is 8%, around 8%. Our cost of fund is below 2%.
Yes.
So I think with a lower cost of fund, we are targeting also the low risk target market, corporate and low risk retail segment. This digital bank, I think they are targeting the higher yielding segment. I think they will help the financial inclusion process in Indonesia by targeting the unbanked population that is not the main target market of the big traditional bank like us. That's, I think, the first answer. Secondly, are we going to create a digital bank? We have to always think about that. In fact, that we are keep monitoring if there is a right candidate in the banking industry that we could acquire, and then later on we convert into a pure digital bank. We are not going to convert the parent company to be a digital bank because it doesn't make sense. We are
Doesn't make sense. Yes.
We are open to with idea to acquire a small bank, convert it to be a pure digital bank, at least to serve like a certain target market, the millennial customer, etc.
Yes. No, that's good. I'm glad that you hit on some of those points, that 70% of the bank is wholesale. It's a traditional bank. I think we always have to remember that, and digitizing the process is actually a good way of putting it. I like that way of understanding it. This concept of the CASA accounts, which is where you have a lot of the transactions in mobile banking, and how that improves your funding costs is, to me, it's very exciting because we know that your term funding is about 30% of your total funding right now. It seems like, and you did mention it in the presentation, that there'll be some decline in the funding cost because term deposits mature, they get repriced at lower rates. I wonder if the bank could actually see some ongoing improvement in funding costs just because your term deposits are still relatively high. And these can come down to 28% of total, to 25% as interest rates are declining. Do you think that's a possibility, Yohan?
Yes, I think that's quite possible. If we look into our funding composition, as you mentioned, 30% is term deposit or time deposit, 70% is CASA, mainly a current account from the wholesale clients and saving account from the retail client, split 50-50 at the moment. So 35, 35, and 30. I think the low-hanging fruit here is the current account from wholesale clients. Why? Because at the moment, we noticed that the penetration of our cash management solution, we call it BNI Direct, is still quite low.
Okay.
I think pretty much around 20%, only 20% of the wholesale clients are already a user of our mobile bank, our BNI Direct or cash management product. We want to push it further to optimize the amount of current account that we go collect from the clients. And we actually, you know, that in BNI, we had a new management team join the bank last year. Most of them came from the other state-owned banks, Bank Mandiri. I think they are quite dominant in wholesale banking. When the new management team joined BNI, the first thing that they look is how strong our transaction banking platform. They look into BNI Direct, cash management platform. And according to their assessment, our reliability and also our feature in BNI Direct is the best among all local banks. So they encourage the relationship manager, RMs, to push this product to the clients.
Okay.
We are doing business differently right now. Right now, for every loan disbursement to the wholesale clients, we require them to put their transaction in BNI, proportional to their funding from BNI. So if the client has like $100 million loan from all banks and $20 million coming from BNI, so it consequently, 1/5 of the transaction has to be in BNI cash management platform.
Good.
And this is a new initiative. This initiative, if we implement consistently in 2-3 years' time, will be a source of growth for our current account. Time deposit is always a balancing factor. When loan growth is not spectacular like this year and probably next year, it will continue to be either negative or just flat. When loan growth is strong, then we are going to rely on time deposit. So right now, we see a lot of hanging fruit from the wholesale low-cost funding.
Yes, okay, good. Sometimes there is concern when marketable securities, gains on securities is a large component of non-interest income. A lot of what BNI is doing is core non-interest income. It's exciting. It's this digital transformation. It's new fees and products for existing clients and gaining new clients. Is there any way that we could understand the marketable securities income stream, how reliable that is, how you consider trading in that income stream?
Yeah, so if we look into the marketable securities fee income, the contribution to total fee income, if we look into the first half data, was only, let me check, 1 trillion out of 6.8 trillion. So maybe only around 15%, 1/5 of the total fee income is not a big chunk of the total fee income. So I could say that our non-interest income growth in the future will be steady growth. It shouldn't be volatile.
It shouldn't come from this number. So that might actually become less and less as a percentage of total. Does that sound right, Yohan?
Correct.
Okay, that's good. That's good to hear. When we're talking about all this transformation, and we're talking about recovery, a much better year next year, possibly even the second half of this year, do you see any of the largest competitor banks as real competitors for what you're specifically trying to achieve? I know there's many small banks in Indonesia, but I'm thinking of the biggest ones who are maybe the most obvious competitors.
Yeah, actually, we are more like disruptor for their business because we start from low base. And our competitor, they are already like, well, we see the landscape of the banking industry. There are big 4 banks. Number 1, 2, and 3 are relatively similar in size. And right. We are maybe like 30% smaller than the first big 3 banks.
Okay.
And we are the bank which are doing ongoing transformation process. And almost in all kind of metrics, financial metrics, we are targeting to be the second best in Indonesia within 3 years' time. We are not targeting to be number 1. I think that's quite a challenging target. We are just targeting to be the second best, meaning that from now, number 4 to be number 2 in all metrics except for size. Okay. We don't really care with size. We changed the mindset of the BNI people that our ultimate goal is to be the most profitable bank as measured by return on equity, not by size. And we want to have the second lowest cost of fund. We want to have the second highest fee ratio, the second lowest cost income ratio, and other indicators. We believe that we are on the right track. Some of the progress that we have been delivering, for example, I mentioned about the progress in mobile banking apps, and also in terms of cost of fund. Right now, we are already number 2, second best already. Cost income ratio, we are already number 2, but the gap with number 3 is quite small. We want to be the gap to be bigger. And I think what we need to push further is that we want to be improving our portfolio, our client portfolio base. Right now, if we talk about our wholesale banking clients, most of our wholesale banking clients are either state-owned enterprise or the second-tier private sector companies. We did not have enough or strong top-tier blue chip companies from private sector. And this is the new target of the management team. This year, we acquired a lot of new names like Saling Group, Sinarmas, even Astra now become our client, Ciputra, and also BSD, one of the largest property developer, also become our new clients. So we believe we are on the right track. For the next 3 years, our focus is to acquire more and more of these corporate clients. And it is possible for us to do so because when we talk with a lot of corporate clients, they do not want to rely only on one bank, on one local bank. They want to have at least 2 local banks. So they open their door for us, and we are going to show the progress from time to time.
That sounds very, very positive. From my perspective, from a bank analyst perspective, I like that story. I like the idea of not looking at size and focusing on profitability. But you mentioned ROE, not ROA. So that begs the question on how you're thinking to manage your capital adequacy. So a lot of times people look at banks in Indonesia and think they're overcapitalized. And of course, this could affect your ROE if you decide to pay out a higher dividend.
Yeah, actually, let me share. Our target for ROE is 16%, 16. Right now, we are just below 10%.
Right.
It is not optimal because we are not fully recovered from the pandemic. I think next year we should be fully recovered from the pandemic, but our target of ROE is 16%. It will be driven mostly by ROE improvement, not higher leverage, not higher leverage. Because what we are doing is the other way around. We are right now is in the process of strengthening our balance, our capital adequacy ratio. Our tier 1 CAR at the moment only 16%, while it is already above the regulatory requirement, but we are laggard compared to our top 3 competitors. And I think it is not good because we are a domestically systemic important banks, number 1. Number 2, we want to tap into the top blue chip corporate clients, and they require higher legal lending limit. For us, we need to have a higher tier 1 capital ratio as well, because the legal lending limit is calculated as a percentage of the tier 1 capital.
Yes.
And also, lastly, we think that this is a good time for us to strengthen our tier 1 capital, especially through additional tier 1, or we call it perpetual bonds. We just launched perpetual bonds last week. I think the timing was perfect. If we do it this week, maybe the yield will not be as good because of China. So the timing was perfect. The bond yield is very, very low. We launched our $600 million perpetual bond only at 4.3% yield.
Yeah, so it's a good time to do it.
Yes. So leverage, we are not increasing the leverage. In fact, we are strengthening our capital. So the most ROE improvement purely coming from ROA improvement. And ROE improvement will be mostly coming from lower credit costs. That's number 1. Our aspiration for cost of risk is around 1.5%. From this year, 3.3 to 3.6. Next year, probably around 2.5. In the long term, should be 1.5% cost of risk. That's the biggest driver. The second driver will be coming from improvement in cost-income ratio. This one will not be a dramatic improvement, but this is a gradual improvement. Every year, we are targeting in our budget that the gap between OPEX growth versus revenue growth will be at least 2%.
Okay. So at the maximum you'll have is 2% positive jaws or negative jaws?
Minimum 2% positive jaws.
Okay.
That's our target.
Okay. And would a third driver be, I mean, if we're looking at these main drivers of your improving returns, margins, because of improving funding costs and improving loan mix, that seems to be very, very important to what's happening with you guys.
Yeah, so actually, when we are doing calculation for our 16% ROE aspiration, we are only assuming flat net interest margin. We just want to be conservative because
very conservative, Yohan.
Yeah, we have to. So what is the upside potential? The upside potential for NIM is that when the pandemic overs, then we expect a lot of clients will be able to repay their loan to us.
Yes.
Why this is a catalyst? Because our accounting policy is very conservative. Whenever the loan is restructured, we do not accrue interest income. We convert into cash basis accounting. And I think, as you know, that during this pandemic, the regulator, OJK, they give relaxation. They ask bank to give grace period for a retail borrower below 10 billion rupiah. So basically, there is no payment from them. There is no quarterly payment. That's why we do not book any interest income from them. So there is a potential upside in net interest margin when the client actually really repay their cumulative deferred interest income to us, probably by second half of next year, because the grace period relaxation by OJK will end by March 2020, next year.
Right. Okay. Yeah. I mean, we don't want to, investors never want banks to be too conservative. To have a rational amount of conservatism is a good thing, but there's at some stage we don't want to be overly conservative. But I do hear what you're saying. There is room for upside surprises, is what it sounds like. A question on government's target lending to SMEs as a proportion of total loans. Do you have a view on this? And is this going to change anything in how you look at the P2P lenders?
Yes, exactly. So right now, the requirement for our exposure to MSME is at least 20% by the government. Right now, we are at 21%. So we met the criteria.
You're right there.
However, the government is targeting the exposure to be increased to be close to 30%. And for us, how we are going to meet this target, number one is actually through KUR or subsidized microloan. We want to be a bigger player in KUR channeling. Why? Because the product is very profitable and the risk is quite manageable, because for every NPL, 70% of the loss is actually insured. So it's low risk and attractive product. And as a state-owned bank, we got privilege from the government to channel this subsidized microloan. And then number two is what you are just mentioning right now, being more, having more exposure in channeling loan through fintech, like peer-to-peer lending. We are in the process of developing the policy on how to do this loan channeling at the moment, but we are getting to be more active player in peer-to-peer lending. Okay,
no, that sounds reasonable. I'm glad to hear that. Can you give your thoughts in general on the multi-finance operators? There's been a lot of renewed interest in BFIN. Maybe some of the overhang has come away from the old shareholder in Europe. But do you have any thoughts on these operators and the renewed interest?
On BFIN, not really, because right now our multi-finance actually is not a big contributor to our business yet. Okay. We are actually in the process of doing transformation to the multi-finance. I think we should give you some good news within the next 1 year.
Okay, that's good to hear. The question I'm sure you're always going to get, Yohan, is how's the third quarter doing? How's the current quarter doing? Is there anything that you can tell us without, telling too much?
Yeah. All right. So I think the most important thing is what is the impact of the social restriction to our P&L and balance sheet? Because as you know that in Indonesia there is a social restriction, we call it PPKM, on July and August. So it impacts 2 months of the third quarter, and what's the impact to our business? On the loan growth, obviously, the loan demand is still subdued. We do not expect a very strong loan demand because of this. However, the most important thing is that our asset quality is proven to be resilient. Yes. We are looking at the two leading indicators. Number one is the amount of restructured loan. Number two is the total amount of loan in collectability 2 or special mention loan. The borrower which are late in term of payment between 1 to 90 days. And so far, from those two indicators, the data until the end of August showing that the restructured loan and collectability 2 loan are still flat to actually slightly lower. So our book is very resilient.
So, and you've already mentioned early on, Yohan, that you're already comfortable, it sounds like, with your NPL coverage ratio. You're comfortable with the current level. So if those metrics are improving and you're comfortable with the current NPL coverage ratio, maybe there is some scope for reducing credit costs a little bit in the third quarter versus the second quarter. Is that reasonable?
I think that's maybe more on the Q4, I think.
Q4, okay.
Yeah. Why? When we are make a decision regarding the provisioning on the quarterly basis, we are relying a lot on the survey on asset quality that we are doing every 4 months. Okay. This month we are doing the survey. next month, maybe by mid or end of October, we should get the survey. That will be the basis for us to make decision on the Q4 cost of credit.
Okay. Well, one thing that I feel that's always interesting as a bank analyst is understanding the premium that you're able to charge over base rates or some kind of benchmark interest rate as demand is improving, as an economy is improving. We always talk about credit costs, and I know that's very important, especially this year compared to last year, especially next year compared to this year. But are you seeing any improvement with a pricing power, just basic pricing power, the premium over the benchmark lending rate?
I would say so far, not really. So far, I think the premium is relatively low compared to what we saw in the past, particularly because we as a domestically systemic important bank, we are also responsible for the overall economic growth. So we are trying to encourage the economic growth recovery. So we are not trying to charge a significant premium for us to maintain or to improve our NIM. We are doing it through cost of fund reduction, not to asset yield improvement. I think at the moment, that's not the right things to do. We should show our support to our clients. During these tough times, I think the economy is not fully recovered yet, obviously. We should show our care to the clients. By doing this, we make sure that they will be a long-term loyal customer to us.
Good, that's good. I like that answer because it also suggests maybe that's something we can consider once everything has improved dramatically, maybe second half next year, for instance.
Yes.
It's another angle that can really help your core income. And there's no shortage of those that I could see for BNI's improving returns. I think it's a very good story. We're nearly out of time, Yohan. I don't know if there's any final point that you feel is important that we didn't discuss. We've gone over a lot of things, or if there's any upcoming regulatory change or something with the government that investors should be aware of?
Not really. So I think when I talk with investors or analysts nowadays, a lot of their questions are actually, they are less concerned with asset quality because in the past 6 months, we have been showing that our asset quality has been improving.
Yes.
But we cannot promise too much because we want to wait until our survey that we are doing. Hopefully next month, we should tell you the result. And I think our gut feeling is that the results should be better because until now, the restructured loan and special mention is improving. So asset quality is less of a concern nowadays. The management team right now is focusing more on how to grab the new business opportunity, for example, in the BNPL business model, and also how to improve cross-selling to the wholesale clients. In the past, we were purely lender, but now we want to be a complete banker. We are no longer lender, but we are a complete banker. We offer a more integrated solution, including financial advisory. That's why we strengthen our IBD team. We just recruit the head of UBS IBD in Indonesia to be the head of BNI Securities. We also just got a license for BNI Securitas in Singapore to help our local corporate clients when they want to tap into US dollar funding, which is, I think now the demand is getting more and more. And then also how to transform our business model into a digital model. So that's pretty much the management focus right now, no longer on asset quality. We believe that we have a good understanding on asset quality and we already set aside enough provisioning. Next year, I think the focus is on how to grow the business in a more sustainable way.
That's good. That's good to hear. A final question, Yohan, before we leave. Remember, we had a few Japanese banks coming into the Indonesian market over different periods of years recently. Do you see anything with more M&A coming through? It doesn't have to be Japan, but other banks in anywhere, really.
I think the pace of M&A will be accelerating in Indonesia. Just last month, OJK released a new regulation regarding the minimum capital requirement to be eligible as bank as a level 1, level 2, level 3, and level 4. There are 4 classifications. Basically, they tighten the requirement So for example, just before the new regulation, there are, I think, like 8 or 9 banks which qualify as the top, the highest tier bank. But now with the new regulation, it become only 4 banks.
Okay.
And then they also issue new regulation that for a bank to be qualified as a digital bank, then the minimum capital requirement is, I think, around 10 trillion rupiah. So basically, OJK, the regulator is trying to push for consolidation in the banking sector. I think this is for their best interest because they want to make sure that the banking sector will be stronger. And also another thing is that we see that there are a lot of growing interest for new players to establish a digital bank in Indonesia. So they acquire a small bank, convert it to be a digital bank. I think this is the trend in the consolidation. I think the trend is accelerating actually.
Okay, well, that's interesting. Okay, I think we will close it at that point, and I'll give it back to Anisha. And I'd like to thank you, Yohan. That was excellent. I'm even more excited with the story about BNI today than I was just 2 days ago.
Thank you very much, Daniel.
Thank you so much, Daniel, for those very intriguing questions. Thank you, Yohan, for deep insight into BNI, for the team, Yudha, Jonathan, and Ananda Elise for sharing a great presentation as well. It's definitely shed more light on BNI and educated everyone much more in terms of not just the transformation, but the company overall. I'd love to thank the audience as well, who have been very engaged and have asked very good questions as well. With that, I would like to close today's webinar and have a great week. If you'd still like to ask questions to the BNI team or Daniel, feel free to send through messages as I shared earlier. It's available on their page on Smartkarma. And with that, thank you all and have a great week.
Thank you. Thank you, Anisha. Thank you, everybody.
Have a good day.